Europe's largest bank said nearly 3/4 of its commercial property loan portfolio in Hong Kong is now at risk, up from less than 30% a year ago. HSBC also said it's taking a hit from its exposure to a Chinese bank as the Chinese banking system as a whole massively retrenches. In fact, the latest statistics on RMB lending showed a $500 billion decline, which was the worst in any July, or any month for that matter, in more than 20 years. So all of that is the backdrop behind some chaotic moves in Hong Kong's dollar today, as well as the continued ultra-low money rates in the city that are puzzling mainstream sources and commentators. Yet all of these things are related. What they all point to is a deepening credit crisis in Hong Kong, China, and beyond. The Hong Kong saga in particular is giving us a glimpse into how that crisis is progressing. And there have been a bunch of new developments, including what we're going to learn from HSBC's window into it. Now, what we do get from the Hong Kong story also helps us make some judgments about how it's really going on the mainland. We've sadly become accustomed to bad bank data from Chinese banks, but these latest figures really take it up a notch in the same way as the situation in Hong Kong does. Anyone remember China's bazooka? How about the Chinese bank recapitalization program? The reason nobody remembers them, even though they've been almost a year ago, was they didn't work. And the reason they didn't work is because the credit crisis that's growing in Hong Kong and China, and also that applies beyond both of those. All of these things go back to one single fatal flaw. And so what we see in Hong Kong and China gives us some insight into that flaw. Now, at the end of July, HSBC Holdings reported a sharper than expected drop in profit, hurt by write-downs from exposures to a Chinese bank and Hong Kong real estate, while the bank pushed ahead with a global restructuring. Its 26% slump in pre-tax profit in the first half of this year showed the challenge ahead for CEO Georges Elledry, as Europe's largest bank racked up losses in China, where it has increasingly pinned its plans for growth in recent years after shrinking in Western markets. And that's what a lot of banks did, especially in the post-pandemic age, thinking China was going to come roaring back. Well, the lockdowns and the consequences to them were going to harm Western and developed world economies. Maybe the Chinese and some emerging markets would emerge unscathed, and just like Xi Jinping miscalculated, HSBC is miscalculating too. And for the same reason, that fatal flaw that I'm talking about, it applies to the entire world. No one has been immune from it. But then just a couple days ago, HSBC also reported Europe's largest bank and Hong Kong's biggest lender, that's HSBC, has flagged nearly 3/4 of its commercial property loans in Hong Kong as risky, highlighting growing concerns amid a prolonged property slump in retail spending and weak office demand. By the end of June, 73% of HSBC's Hong Kong commercial real estate loan book, totaling $32 billion out of $234 billion Hong Kong loan portfolio, was either classified as impaired or marked as bearing increased credit risk. This marks a sharp rise from less than 30% a year ago, signaling mounting financial pressures in the city's property market that extends beyond just Hong Kong. But Hong Kong is going to give us some insights into what is a credit crisis that goes beyond just Hong Kong. The credit crisis that is the common flaw that we see everywhere. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video, and now let's get back to it. Now, this doesn't mean HSBC is at risk of failing. Instead, The difficulties the bank is experiencing tell us a lot that's important about the wider macroeconomic and financial conditions. And as we go forward, keep in mind where all this is coming from, not just in Hong Kong, this fatal flaw. Valuations worldwide were pushed sky high 3 and 4 years ago by widespread belief that governments had created a long-run recovery. In fact, many people came to believe that they had done too good a job and made it inflationary, which everyone associates with an overheating economy. And it was all a lie. It was all an illusion, a price illusion of basic economics that practically everyone missed. Now, here we are here in 2025, and all over the world, we're having to deal with and pay for that massive lie. It explains everything from Hong Kong's bubble and now bust to China's credit crisis and a whole bunch more in between. It is the entire forgot how to grow dynamic. And we're seeing all of these things start to really come to a head in Hong Kong, starting with the Hong Kong dollar. Now, the Hong Kong Monetary Authority earlier today bought around 3.4 billion HKD to move the currency exchange value away from the lower end of its band. It was able to move the rate up to 783 for the first time in months. The exchange value has been stuck right at the lower limit of 785 ever since mid-June, when everything really started to go down in commercial property and banking. Now, the Hong Kong dollar had been on the rise as a global warning earlier in the year, money seeking the perceived safety of Hong Kong throughout the financial volatility which erupted around February. Then it kept going through the inflationary events in April. Then the Hong Kong dollar hit its upper limit in early May, which then triggered a response by the Hong Kong Monetary Authority, record interventions buying US dollars and issuing new Hong Kong dollar reserves as proceeds. And those proceeds then flooded the Hong Kong money markets, which then sent money market rates plunging toward and eventually getting to zero. And at the same time, the Hong Kong dollar, which had been strong at the upper end of its range, plunged, going all the way from the upper limit to the lower limit in basically unprecedented fashion and with unparalleled speed. It only took about a month to go from the one to the other. But it's what happened and what didn't happen during that move which gives us clues about what's really going on in Hong Kong, and then from Hong Kong, how things are progressing everywhere else. Now, what would normally happen as money rates plunged in Hong Kong is that would trigger a carry trade. Well-connected financial firms would use that cheap leverage and then go out into the rest of the world and buy higher-yielding safe assets all over the rest of the planet. Once the carry trade ignited, that mediates both money rates and the exchange value. And as carry traders borrow cheap Hong Kong dollars, those money rates would rise and normalize. And by reinvesting that leverage overseas, it also weakens the Hong Kong dollar at the same time. But in this case, Hong Kong dollar didn't just weaken, it got absolutely slammed. And on top of that, Hong Kong money rates have barely moved. So the exchange value went way too far, and it doesn't appear as if the carry traders showed up at all to borrow the cheap leverage. In fact, as of today, it took the sizable intervention by the Hong Kong Monetary Authority just to move the exchange value up from 785. Meanwhile, the overnight HIBOR rate, which is the main unsecured lending rate, interbank rate in Hong Kong, is still just 0.376%, and the 1 week merely 0.537%. Even the 3-month rate, just 1.72%. So a couple big parts of this story are missing. And even the mainstream media is having trouble figuring out why that is. As Bloomberg reported a couple days ago, Hong Kong is confronted with 2 gravity-defying puzzles this year. Investors are asking why the city's interest rates are so low, and yet the housing market is so bad. In fact, investors aren't asking anything. They already know the answers. But as the article continues, it's not supposed to be this way. Carry trades, whereby investors borrow Hong Kong dollars and sell them against higher-yielding U.S. counterparts, are able to close that rate gap. And this seemingly risk-free arbitrage would have been profitable for 3 months. One explanation for the persistent rate differential is little appetite for the carry trade. Now, Bloomberg talks about the possibility of HKMA breaking its peg, but the answer is in the first paragraph that I just read to you. There is no carry trade because the property sector isn't going to be fixed by lower interest rates. In fact, interest rates are down because the property sector is in such trouble. There is no gravity-defying puzzle here. It's just that the fatal flaw and the consequences of that fatal flaw explain everything we're seeing in Hong Kong and beyond. It's just that the media doesn't want to admit that there is this fatal flaw because it upends basically everything. Now, what was going on during the time when the Hong Kong dollar was falling and really plunging from the upper limit to the lower limit? Remember New World and the credit crisis? So rather than carry trading, the record plunge in the Hong Kong dollar instead signaled a one-way trade where more money, organic money, was fleeing Hong Kong rather than taking advantage of leveraging cheap funding. And we have to keep in mind what was unfolding while all this was literally going down in May and June. First, the New World saga. The big developer was facing not just a maturity cliff, it was an absolute chasm. And because New World is so large and most of the banks are exposed in some way to it, the city's banks, seemingly all of them, got together to cobble a syndicated loan rescue. And even then, it took until the 11th hour to finally secure all the commitments, showing just how difficult and troubled the deal was. And the only reason it really got done is that none of the balking banks wanted to risk not getting it done. It was very reminiscent of what happened with LTCM in 1998. Though no one wanted to get deeper in bed with LTCM, they all did because the alternative would have been far worse. Same with New World. As Hong Kong banks clearly didn't want to do this, or the funding would have been put together long before the deadline, yet at the same time, they didn't want to see what would happen if it didn't go through. But here's the thing. Putting together the syndicated loan for New World wasn't the end of the property sector trouble. It was just one of the biggest sore spots in a large number of sore spots all around the city and therefore the banking sector. That wasn't the end of it. It may have been the end of the beginning of it. As Bloomberg reported back on July 1st, New World Development, a major residential and commercial property firm controlled by one of Hong Kong's wealthiest families, completed a big loan refinancing that during that week, the largest of its kind in the city, and one of the biggest that ever been put together. The deal came after months of grueling negotiations with over 50 banks. But elsewhere in the city, distress still lingers. Property prices are near a 9-year low after shedding a third of their value in 4 years. Leaving more households in negative equity than at any time over the past 2 decades. The New World deal just buys some time for Hong Kong to solve its property problem, and authorities might need to take more proactive measures targeting the property sector, said Carlos Casanova, a senior Asia economist at Union Bancaire Privée. But kicking the can only works if the only thing that's needed is time. But that's not what we're seeing in Hong Kong or anywhere else. Time doesn't fix these things. That's especially the lesson that we're getting from mainland China. But we're also seeing it in Hong Kong. As I mentioned, money rates continue to be very low. The Hong Kong dollar continues to be very weak, unusually weak. That it can't be explained by any carry trading because that doesn't seem to be happening. Low HIBOR rates are Hong Kong banks only lending to the best quality borrowers. It's risk aversion. It's low rates signaling a liquidity preference to conserve cash. So no one is lending or borrowing in the interbank market. And Hong Kong dollar plunged because, as I said, what money that could flee did flee, seeking safety someplace other than what is supposed to be one of the world's safest jurisdictions. And these two measures tell us how the credit crisis is progressing, not that it's being resolved. Time doesn't matter. Time doesn't solve. You can't kick the can down the road because down the road, you still got massive problems. What we're seeing out of Hong Kong is that, first of all, the credit crisis is bad. Remember where else it's coming from, the forgot how to grow world. And number two, it's not getting any better. The longer that it gets dragged out and the more the effort that's put into it, the worse it seems to get. Nothing seems to actually change. That's what we see in mainland China. And if the credit crisis is that bad in Hong Kong, where the city is only grappling with a relatively recent commercial property bubble, what does that say about the situation in mainland China? We know the credit crisis in China is much bigger and more widespread, even in the absence of any specific information like we're getting from Hong Kong. We only need to look at the aggregate bank data. In terms of total social financing, new RMB loans crashed in July. They absolutely crashed in July. Flows into loans from banks dropped by 429 billion yuan, a gigantic setback. Now, July is typically one of the weakest months for bank lending on the annual calendar because following June, when banks and companies are rushing to hit quotas or these days just hit minimums, there's a lull afterward. But that size of negative for July, it's the worst in at least 20 years for the month, and it's the worst for any single month in a couple decades too. But this result is far too emblematic of what China's banking system has been reduced to, a bigger, more entrenched credit crisis version of Hong Kong. Just to show you it's not something recent, total flows into bank loans in China year to date are actually 0.6% below last year, when last year meant big trouble in terms of that credit crisis, banks retrenching and refusing to lend. Loan flows were down 23% January to July 2024 compared to the same months in 2023. So here in 2025, they're even worse, and that's in spite of constant, even escalating, quote-unquote stimulus from the government. Anyone remember the bazooka? How about the bank recapitalization plan? These gigantic fiscal measures, everyone went crazy over them. The huge numbers, the big plans, lower interest rates. Remember the strategy shift by the PBOC from last December? It was supposed to be a huge deal, they said. The central bank was flipping from prudent to moderately loose, and that was going to fill China with money. But as I keep having to point out, it does not matter what central banks and central authorities do, only what banks do, or in these cases, don't do. Money comes from the banks, and it gets circulated by banks. Nobody remembers the bazookas because they didn't do anything. Chinese banks continue to get worse and worse. They continue to retrench no matter what Beijing does. But why? This is where the analogy to Hong Kong's issues comes in. There's only one way to explain all the facts in the city, from low money rates to the behavior of exchange values and even lenders. It's a credit crisis stemming from a large bubble stoked by global distortions created during the pandemic and its aftermath. Mainland China doesn't have a pandemic bubble in commercial real estate. It has a more than decade-long bubble in all real estate and property. And the downside to it was triggered by Xi Jinping's misreading of the global economy back in 2021, the fatal flaw, thinking it was a full-on recovery that would benefit China more than anywhere else, rather than realizing it was entirely fake, all a price illusion. Xi thought he would be able to harness that strong global recovery to begin cleaning up the credit crisis in property. Banks would be able to gain massive profits from lending into the economic boom to cover their losses from the past 10 plus years of overextended real estate. Instead, the Chinese economy, like the global economy, failed. The losses kept piling up in the banks, and now they're paralyzed, if not worse. And so the economy is also stuck. Banks won't lend, which means they aren't intermediating a necessary component to any healthy economy. Money needs to cycle and recycle through credit creation. This is why central bank policies are worthless when banks are systemically impaired. It also explains why none of the stimulus is having any effect on the real economy, even if China is able to occasionally beat the heavily reduced expectations for a couple of macro accounts like GDP. But the reality of failed fiscal policies won't stop the fiscal policies. I mean, for example, just to show you here, government bond issuance has been gigantic since August of 2024, an entire year of floating central government securities. Using the same total social financing data that we referenced before, new government bond financing year to date in 2025 has been 8.9 trillion yuan. That compared to 4 trillion January to July 2024 and 3.8 trillion in the same months of 2023. But rather than stimulating economic activity, which we don't see, and hopefully growth from there, these bond issues might actually be making the situation worse, especially among banks. It's the old crowding out phenomenon. Banks are suffering from a credit crisis, so they want safe assets, being heavily risk averse, just like in Hong Kong. So they buy every last government bond that's being issued, which is why interest rates haven't gone anywhere despite the 16.2 trillion sold to them over the past 12 months. But the more they take on those government securities, the less willing they are to lend in the real economy. Why lend anywhere when you have access to more and more safe assets? You can actually see banks extending deposits to pay for these bonds in the M2 figure. Now, M2 growth bottomed out last June, July, and August, but then it began to accelerate afterwards as banks created new deposits as they were buying more government bonds. At the same time, they were cutting back more and more and more on new loan growth. They're trading the one for the other, classic crowding out and depression economics. Again, like we see in Hong Kong, China's banks aren't behaving that way except for the one reason. Not just depression economics, but depression economics coming from a credit crisis. In fact, Hong Kong's bust gives us some insight into what's happening in mainland China. But a credit crisis, however, doesn't mean liquidity or monetary crisis. The one can become the other if things really start to go wrong, where it gets so bad banks not only pull back from lending in the real economy, they pull back from each other and stop circulating funding in money and interbank markets. Now, we've only seen glimpses of the occasional hiccups in money markets thus far, like earlier this year in January, February in mainland China, leading up to the Golden Week and then a couple of weeks afterward. Setting aside the danger of a liquidity crisis, even just a credit crisis is a huge drag on economic growth and creates tremendous amounts of financial volatility, so it already has an impact on the global system. But given how important Hong Kong and China are to that global system, this drag, the financial volatility, doesn't remain strictly local. The consequences of forgot how to grow become global, and what we're seeing of the credit crisis in Hong Kong and China are another reason why interest rates go down, and they go down a lot, and they stay there for a long time. It all goes back to the fatal flaw. There was no recovery, and the consequences, as we're seeing, still have to be paid for. I went into more detail behind what really went on with New World in a video from a couple months ago, and that's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers, and until next time, take care.